Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. Hope you guys are doing well. Make sure you like, subscribe, follow us on all social media, whether it be YouTube, Rumble, Facebook, Instagram, LinkedIn, and you can make sure to follow us in case something's down. Maybe you got to jump over to something else. Also, if you're not already getting it, please make sure you're on our email list to get our weekly email. Wanted to make sure that we updated you on the jobs report. I mentioned this in my market report earlier this week, and that came out today. So I'm going to share my screen with you here real quick. And why this is important is because the Fed looks at this as an indicator of whether or not they're taming inflation by basically raising the Fed's fund rate, which has also caused a lot of other issues, which we talked about before, like some of the bank collapses and people having higher credit card bills. Up to $1 trillion now, which is a big issue. Up to $1 trillion in credit card debt for the U.S. economy, U.S. taxpayers. And, also we have seen that part of what they're trying to do by taming inflation is slow down productivity, which slows down spending. Because if you have, companies kind of not growing, they're not doing more acquisitions, they're not hiring more people, they're not doing the things that they would normally do to grow their business. And right, wrong, good or bad, whether you like the Fed or not, they drive me crazy, but that's just how they look at things and that's how they do it. So their indicator here that, and of course they're way behind, they're months behind, all their information's lagging, and it's been manipulated over the last several months we talked about, and we've talked about this in other videos before. But the Fed's seen likely done with rate hikes is the title here. As job market cools, they're finally realizing that everybody's hurting, I guess. All of the economic indicators, for jobs growth and all that, people losing hours, people going on unemployment is starting to finally get, in their rearview mirror, because they look in the rearview mirror. Rather than looking at what's going on now or, at the actual numbers in the actual economy. Because right now, everybody knows the actual economy is not doing that great. The real economy is not doing that great, and kind of the underpinning there. And, probably by the end of the year, we'll probably be in a recession, guys. But what happens during recessions? Interest rates go down. And we see that them not raising the Fed's fund rate, although Fed's fund rate indirectly deals with mortgage rates. It does deal with things like credit cards, debt and interest rate, and whether, when you go to buy a car and all those other trade lines of credit and everything, that's where that Fed rate comes in. So they're saying that they're going to basically look at things over, in this report, they're basically going to be, looking at things over the next, September, October, probably not doing anything as far as raising. Whether or not they're going to be lowering the Fed fund rate, we'll have to wait and see. But that's it in a nutshell, guys. This is good news as far as inflation being tamed, and from the standpoint of how they look at it. I know it sounds crazy that they want to destroy job growth, but that's the mess they got us in, and that's where we are. Inflation drives mortgage rates. What drives inflation? The printing of unnecessary dollars by the Federal Reserve, central banks. And so, but they make money by printing money, right? So this is what we've got to be looking at. We got to be looking at what they're looking at, what will change, and what kind of be ready for these things. Now, when rates go down, there is a lot of pent up demand out there. So when we see inflation come down, rates will come down. And we'll probably see that over the next couple of months, 2, 3, 4 months. And we'll see, where you want to be ahead of that curve, because we've already got a low inventory situation on homes, guys. So when those rates drop, there's going to be even more competition than there is now. And there's still quite a bit of competition here in the Phoenix metro area and even across the country, because inventory is low. There's still pretty good demand in general. And there's going to be a hyper demand once those rates drop, even around 6-5%. With new homes right now, a lot of them are already offering lower interest rates due to the concessions that they're offering in a lot of new builds. but those new builds are lagging and keeping up with the demand now. Just imagine when those rates drop even to, below 6 or 5%. Okay. One other thing, I almost forgot. I wanted to just show you this real quick. Just in the last day since this has happened, if you look at the mortgage rate thing over here on the left of the screen, and again, this is a kind of an average that they show here on Mortgage News Daily. If you go with one of our brokers, you're probably going to end up with a lower interest rate than this. But 30-year fixed rate just dropped in the last, few days, in the last week, because of these things that are going on that we keep up with on our end. So, guys, if you have any questions at all, 480-788-8569. Okay. MincolaGroup.com, MincolaHomes.com, home@MincolaGroup.com if you want to email us, and make sure you're following us, liking us, and sharing this with your friends and family. And we'll see you guys next time.